Welcome to the Deep Dive. Our mission today, well, it's cutting through the noise of corporate disclosures to bring you the intelligence that actually matters. And today, we are zeroing in on State Street Corporation's Q3 2025 earnings call. We've sifted through, the presentations, the Q&A, all of it, and the clear message: sustained momentum, driven by really disciplined execution. So we'll give you that quick snapshot first, then break down the strategic moves behind what they called strong financial performance.
Yeah.
And we'll finish up with some balance sheet details management thinks the market's kind of missing.
Exactly. Q3 wasn't just like a good quarter riding the market wave. It felt like the culmination of several longer-term strategies really starting to hit the numbers. Their story focuses on, let's say, three things: boosting that fee-based growth, getting more efficient with their operating leverage, and deploying capital smartly. And importantly, they're setting up some pretty specific tailwinds for, looking ahead into 2026.
Okay, let's start with that snapshot then. What were the big headline numbers, the ones that made people sit up?
Yeah, the top line was undeniably strong. Earnings per share, EPS, hit $2.78. That's a sharp 23% jump year over year.
Wow, 23%.
Yeah. And total revenue, around $3.5 billion, up 9% compared to last year. So these aren't small moves. It shows growth is, accelerating, compounding even.
Okay, beyond just the dollars and cents, what about their internal engine? Is there a metric that shows this growth is, efficient and maybe sustainable?
Absolutely. The big one there is operating leverage. And this is crucial. It marks their seventh straight quarter of positive total operating leverage if you exclude the notable items.
Seventh quarter. Okay.
Right. Simply put, revenue's growing faster than costs. And that really points to their ability, to manage expenses tightly even as the business expands. It let them deliver a 31% pre-tax margin.
And just the sheer size of the operation continues to grow. Those key indicators, AUCA and AUM.
Huge numbers. Assets under custody and administration, the AUCA hit a new record, $51.7 trillion.
$51.7 trillion.
Trillion, yeah. And assets under management, AUM, also a record, $5.4 trillion. Which is pretty impressive when you think they only crossed the $5 trillion mark for the first time, like last quarter.
So that massive scale in AUCA and AUM, that's the foundation for the fee revenue growth.
Exactly. That's the backbone. If you look at their core operations, fee revenue was up nearly 12% year over year, adjusted for those one-off things.
Yeah.
And it was pretty broad-based growth, too, across the board.
And the investment management part specifically. Sounded like it was doing really well.
Yeah, it was humming. Management fees jumped 16%, and that was driven by really healthy net inflows, money coming into ETFs, cash, and institutional index fixed income.
Right, those ETFs.
And speaking of ETFs, that gold ETF suite is a great example. It just keeps strengthening its market position. Now managing a record, roughly $145 billion in AUM.
$145 billion just in gold ETFs. That provides some serious stability, I imagine.
Huge stability for the fee base, yeah.
But they're not just sitting on index funds, right? They mentioned new products.
Right, they're innovating. Launched 39 new products this quarter alone, including 11 of those select sector premium income ETFs.
Income focus, that makes sense.
Yeah, it shows they're trying to capture that demand, from both retail and institutional clients looking for yield.
Okay, what about the markets business? Sometimes that's more volatile.
It actually acted as a really critical sort of integrated engine this quarter, delivered robust results. Revenue from FX trading and securities finance together, up 17% year over year, again, excluding the non-core stuff.
17%. But wasn't market volatility kind of muted during Q3? What drove that growth then?
Good question. It wasn't market swings, it was client activity, sheer volume. They saw an 11% rise in client volumes in FX trading, and really solid balance growth in agency lending and prime services.
So it's core client business, not just market bets.
Exactly. It highlights how their markets franchise isn't separate. It acts as an integrated flow driver for their other businesses. Servicing, investment management, they all connect.
Okay, that fee story seems pretty strong. Let's switch gears to the balance sheet. Always a focus in this rate environment. Net interest income, NII.
Right, NII. The difference between interest earned and paid, it was down slightly 1% year over year, came in at $715 million. And the net interest margin, NIM, was 96 basis points.
Sequentially, quarter over quarter, it was down a bit more?
Down 2% sequentially, yeah. They said that was mainly due to lower deposit balances compared to Q2, which were unusually high then. But here's the key thing. The NIM itself, the margin, held stable compared to Q2.
Okay. Stable NEM, that's important.
Very important. It suggests the pressure on the margin might be easing up, stabilizing, partly helped by them, reinvesting cash flows from their securities portfolio at potentially higher rates.
Got it. Now, expenses, costs were up about 5% year over year. Some currency impact, but also investment.
Yeah, investment was a big piece. Continued spending on tech, especially platform upgrades and AI tools.
So that 5% increase, does it just eat up all those productivity savings they talk about? Because they did mention savings, right?
They did. That's the right question. They generated about $125 million in year-over-year savings in the quarter. That brings the total so far this year to $370 million.
They're on track for the full year target.
Looks like it. They're on track for the $500 million target. So while 5% expense growth sounds high, management's argument is that those savings are actually funding these strategic investments, things like AI, things they believe will generate higher returns down the line. And they're doing it while still maintaining that positive operating leverage overall. It's framed as a reinvestment, not just costs running away.
Okay, so where is that investment money going? You mentioned AI. What else? They seem to be pushing beyond just core custody.
Definitely. They're really positioning themselves, the words were the bridge between traditional and digital finance.
The bridge, okay. How?
Well, they announced they're launching a digital asset platform soon. It's designed to enable tokenization, turning assets, funds, even cash into digital tokens for their big institutional clients.
So not crypto for the masses, but institutional infrastructure.
Exactly. This is about capturing that big shift happening with institutions, digitizing operations, tokenizing assets, basically future-proofing their main servicing business.
And the other big move was into wealth management services. I found that interesting. The partnership with Apex FinTech Solutions.
Yeah, a strategic partnership and a minority investment in Apex.
Why is wealth services so important for State Street right now?
It's crucial, really. The custody landscape for wealth advisors, it's kind of fragmented. It's ripe for an upgrade, for modernization. This Apex partnership is about building something different, a global, scalable, digital custody and clearing solution specifically for those advisors.
So a new market for them.
A new, potentially high-growth market. They can leverage their huge scale, their regulatory know-how to offer this modern platform that maybe smaller players just can't match.
And all this confidence seems to be reflected in their guidance updates.
Oh, yeah. They raised their full-year total fee revenue guidance significantly, now expecting 8.5% to 9% growth.
Which is way up from what was it before?
Before it was at or slightly above the 5% to 7% range. So quite a jump.
That's a big hike mid-year. Signals real conviction.
Absolutely. Shows they believe the execution's working and the market's cooperating. Now, on the flip side, full-year NII is still expected to be down slightly from last year's record, and they did nudge up the expense growth outlook slightly to around 4.5%, but they tied that directly to the higher investments needed because of the better revenue picture.
Makes sense. And capital return. Still sending cash back to shareholders.
Yep. Committed to an 80% total payout ratio for 2025, and they increased the quarterly dividend again, up 11% to 84 cents per share.
Okay, let's try to unpack the core investment story here. Strong numbers, raised guidance. But management seemed to hint that the market still doesn't fully appreciate it. Why the skepticism?
Yeah, the new CFO, John Woods, addressed that directly. He felt the market sometimes gets too caught up in, macro stuff or just broad custody trends. He pointed to two areas he thinks are underappreciated. First, the core net fee growth. If you strip out market effects like FX changes or equity gains,
the underlying business growth.
Exactly. They still saw 5% net growth in investment management fees and 2% in servicing fees. That shows the organic health separate from market volatility.
Okay, and the second underappreciated area.
The integrated value of their markets business, how it acts not just as its own profit center, but as a flow driver for custody clients, and also kind of a shock absorber for the whole company if other parts slow down.
Right. Now, you mentioned earlier some specific balance sheet factors related to NII stability. Management got pretty granular here, didn't they? Talk about non-rate dependent tailwinds.
They did, and this is where it gets interesting, moving beyond just guessing the Fed's next move. They highlighted two specific things driving NII into Q4 and 2026 that aren't dependent on interest rate changes.
All right, what's the first one?
It's the steady, recurring turnover of their investment portfolio. Think of it like this. They have about $5 billion in cash flows maturing each quarter from older investments made at lower rates. When they reinvest that cash now, they're locking in yields that are currently like 75 to 100 basis points higher than the old stuff.
So it's a built-in lift just from reinvesting maturing assets.
Exactly. A structural lift to NII, regardless of short-term Fed moves. It provides stability.
Okay, and the second factor, something about hedges, managing interest rate risk.
Precisely. They had a negative drag on NII coming from some interest rate hedges they had terminated previously. These were put on at different times, and basically they were costing them money currently.
Yeah.
But the key point is, management said that drag is already fully baked into their Q3 numbers, the current run rate.
So it's already reflected.
It's already reflected. And critically, that drag starts to actively run down in Q4. It starts decreasing. So as that negative drag shrinks and rolls off, it becomes a positive tailwind for NII and income growth going into 2026. And importantly, it's predictable. It's structural, not just a macro guess.
That is subtle, but potentially quite powerful if the market isn't pricing it in. Okay, one last area, Alpha, their big integrated platform solution. There's been skepticism about implementation timelines in the past. What's the update there?
Yeah, execution on Alpha is key. The proof point they offered is the backlog and the speed. The backlog for servicing fees tied to Alpha deals is now around $400 million. That's up 40% year over year.
40% growth in the backlog. But can they install it fast enough?
That was the other point. Management expressed high confidence in the installation pace. They specifically said newer mandates, especially ones focused on back office functions in private markets, are getting implemented faster than some of the earlier, maybe more complex Alpha deals.
So they're learning, getting better at the process.
It shows real improvement, yeah. Learning, optimizing the process. They're showing they can convert that growing backlog into actual revenue more quickly.
So pulling it all together, the narrative seems to be operational strengths funds, investment in future growth, AI, Alpha, wealth, while still delivering leverage and returning capital.
That's the pitch. They see their strong capital position allowing them to do both simultaneously. Fund strategic additions like the Apex deal, which speeds up their strategy, while still hitting that aggressive 80% payout target for the year. They feel they can walk and chew gum at the same time, basically.
All right, time for our slightly outrageous, but hopefully plausible trade idea built purely on the details we've just dug into. And remember, folks, this is absolutely not financial advice, just a thought experiment.
Okay, here goes. Given that big jump in fee guidance, the integrated growth story that seems to be working, A&ED, those very specific non-rate dependent NII tailwinds we just discussed, our thinking is the market might still be valuing State Street too much like a simple, slow growth custody bank and not enough like a diversified platform with these unique, stabilizing balance sheet dynamics.
So how would someone hypothetically play that perception gap?
The trade idea. Go long State Street common stock and potentially finance it by shorting a basket of, say, regional banks that are much more exposed to general NII swings based on interest rates and that lack State Street's big fee buffers and those specific structural NII tailwinds.
Okay, long State Street, short rate-sensitive regionals. What's the catalyst? When does this perception gap close?
The catalyst would likely be the Q4 earnings report and maybe Q1 of next year. That's when the benefit from that hedge runoff, that second NII tailwind, should become really explicit and quantifiable in the numbers. When that happens, it should widen State Street's relative NIM advantage compared to those more rate-sensitive peers. And that could be what forces the market to correct the underappreciated valuation story management keeps highlighting.
Interesting. Okay, we've covered a ton of ground from that 23% EPS jump and the record $51.7 trillion AUCA to the Apex deal, the digital asset plans. But the core themes seem pretty clear. Number one, operational excellence. That seventh straight quarter of positive leverage is hard to ignore. Number two, strategic moves into digital and wealth. And number three, a management team confident enough to raise guidance while pointing to some pretty specific reasons why NII might be more resilient than people think heading into 2026.
And remember, those NII details, the portfolio rollover, the hedge runoff, those are the kind of subtle company-specific factors, not just macro bets, that could really differentiate their performance. Especially if the rate environment stays uncertain, it's about looking beyond the headline.
So if you're trying to get ahead of the curve on understanding how execution meets strategy, hopefully you've got some good pointers now. Thank you for joining us for this deep dive.